Every time inflation cools down even a little, Americans start asking the same question. When will the Federal Reserve finally cut interest rates? People want cheaper mortgages, lower credit card interest, cheaper car loans, and relief for the economy. But despite months of pressure from Wall Street politicians and struggling consumers, the Fed keeps holding rates higher for longer. So what's really going on behind the scenes? Is the economy secretly stronger than people think? Or is the Federal Reserve terrified of making the same mistake that caused past inflation disasters? Today, we're breaking down the real reason the Fed refuses to cut rates and why it affects your money more than most Americans realize. Welcome back to the Dollar Pilot. Over the last few years, interest rates in the United States have become one of the biggest financial stories in the entire economy. After inflation surged to levels Americans hadn't seen in decades, the Federal Reserve aggressively raised interest rates in an attempt to slow the economy down. Their goal was simple: reduce inflation by making borrowing more expensive. And honestly, that strategy has worked to some degree. Inflation has cooled significantly from its peak levels. Gas prices stabilized in many areas, supply chains improved, and consumer spending slowed compared to the post-pandemic boom. But despite inflation improving, the Federal Reserve still seems very cautious about cutting rates too quickly. Why? Because the Fed is worried inflation could come back stronger if they ease financial conditions too early. Historically, this has happened before. Back in the 1970s, the United States experienced major inflation problems. The Federal Reserve attempted to loosen monetary policy too soon, and inflation came roaring back even worse. That mistake forced the economy into painful rate hikes later on. Today's Federal Reserve leadership knows that history very well. They understand that once inflation expectations become deeply embedded into the economy, controlling prices becomes much harder. If businesses and consumers believe prices will keep rising, they start behaving differently. Workers demand higher wages, companies raise prices faster, and inflation can become self-sustaining. That's exactly what the Fed wants to avoid. Another reason the Federal Reserve won't rush into rate cuts is because the U.S. economy remains surprisingly resilient. Even with high interest rates, the labor market has stayed relatively strong compared to what many economists expected. Consumer spending continues in many sectors, unemployment remains fairly low historically, and corporate earnings in parts of the economy are still strong. This creates a difficult balancing act. If the Fed cuts rates too early while the economy remains stable, financial conditions could loosen rapidly. Stock markets could surge higher. Borrowing could increase again. Housing prices could re-accelerate, and inflation pressures could return. And the Federal Reserve knows that financial markets react very quickly to easier money. The moment investors expect lower rates, markets often rally aggressively. Mortgage demand can increase. Asset prices rise. Risk-taking behavior returns. That's why the phrase "higher for longer" became so important in financial markets recently. The Federal Reserve wants consumers, businesses, and investors to believe rates may stay elevated until inflation is truly under control. There's also another important factor here: government debt. The United States currently holds massive levels of national debt, and interest payments on that debt continue rising as rates remain elevated. Some people believe this creates pressure on policymakers to eventually lower rates again. However, cutting rates too quickly could weaken confidence in the Fed's commitment to controlling inflation. And credibility matters enormously for central banks. If markets stop believing the Federal Reserve can control inflation, long-term financial stability becomes much harder to maintain. Now, for average Americans, high interest rates impact everyday life in very real ways. Credit card interest rates have surged. Auto loans became more expensive. Mortgage payments increased dramatically. Businesses face higher borrowing costs, and many consumers feel financially squeezed. Young Americans trying to buy homes have been hit especially hard. Housing affordability became one of the biggest financial challenges in the country because higher mortgage rates dramatically increased monthly payments. At the same time, small businesses also face pressure because borrowing money for expansion or operations now costs far more than it did during the era of near-zero interest rates. But here's the reality many investors understand. The Federal Reserve doesn't primarily focus on making markets happy. Their main goals are controlling inflation and maintaining employment stability. And from the Fed's perspective, cutting rates too early could risk undoing years of inflation-fighting progress. This is why financial markets constantly react to economic data reports. Every inflation report, jobs report, GDP number, and consumer spending update can influence expectations around future Fed policy. Investors are constantly searching for clues about when rate cuts might finally happen. And honestly, that uncertainty creates volatility across the stock market, bond market, real estate market, and even cryptocurrency markets. But long-term investors understand something important here. Trying to perfectly predict Federal Reserve decisions is extremely difficult. Even professional economists regularly get rate predictions wrong because the economy changes constantly. That's why many disciplined investors continue focusing on long-term strategies like dollar-cost averaging, diversified index fund investing, and maintaining emergency savings rather than reacting emotionally to every Fed headline. Because over time, markets usually adapt. The economy goes through cycles. Interest rates rise and fall. Inflation comes and goes. Recessions happen. Recoveries happen. But emotional financial decisions during uncertain times often hurt people far more than the actual economic cycle itself. At the end of the day, the Federal Reserve is trying to slow inflation without completely breaking the economy, and that's an incredibly difficult job. If they keep rates too high for too long, they risk slowing growth too aggressively and potentially triggering recession risks. But if they cut too early, inflation could surge again and create even bigger problems later. That's why the Fed remains cautious. And until inflation convincingly stays under control, Americans may continue living in a world of higher borrowing costs, expensive loans, and economic uncertainty. Because right now, from the Federal Reserve's perspective, protecting long-term stability matters more than delivering short-term relief.